Inflation is a topic everyone is talking about, but how much do we really understand it? While inflation is still high compared to historical standards, it's recently started to slow down. But what does this mean for you as an investor or consumer? Let's break it down. First, let's define inflation. Simply put, it's the rate at which prices for goods and services rise over time. Inflation price of everyday items like bread, milk and eggs have risen, and this is directly tied to inflation. But it's not just food. Transportation costs, energy prices and housing have all been hit too. Speaking of housing, inflation is a key driver of mortgage rates. The higher inflation goes, the more the central bank, like the Federal Reserve in the US, may raise interest rates to curb inflation. This directly affects mortgage rates, making home loans more expensive. Now, for consumers, affect their stock prices. On the other hand, certain sectors like real estate, commodities, and inflation-protected securities tend to perform better when inflation is high. As an investor, it's important to stay ahead of these trends. To hedge against inflation, you might consider diversifying your portfolio with assets that tend to outperform in inflationary environments, like gold or treasury inflation-protected securities, also known as TIPS. For individuals, managing inflation overall affordability. So while inflation is slowing down, it's still something to watch closely. Understanding how it impacts prices, interest rates, and consumer behavior can help you make smarter decisions whether you're investing or budgeting for the future. How are you managing inflation in your life? Drop your tips below, and don't forget to subscribe for more financial insights.